Welcome back to Wealthy Business, the channel where we decode finance, global news, and personal growth strategies so you can stay ahead of the curve. This week, two very different stories dominated the financial and corporate world. And while one grabbed the gossip headlines, the other has the potential to reshape markets across Europe. First, let's talk about what had the newsroom buzzing at the water cooler. In Europe and Asia, two corporate giants were rocked by CEO scandals. Nestlé's boss resigned after revelations of an undisclosed affair with a subordinate, while Suntory's CEO stepped down amid allegations connected to illegal substances. These stories may feel like corporate soap operas, but they also highlight a deeper trend: the growing demand for transparency and accountability in leadership. In today's world, a CEO is not just a strategist. They are a public face, a symbol of trust for investors, employees, and consumers alike. When trust is broken, it doesn't just affect internal morale. It can ripple into stock prices, investor sentiment, and even consumer confidence. But while these headlines are shocking, they're not the real story shaking financial markets this week. The real action has been in the bond markets. Analysts have described the moves in European yields, particularly in the UK gilt market and across Europe, as some of the most dramatic in decades. And at the epicenter of this storm, France. On Monday, Prime Minister François Bayrou faces a confidence vote, and the ruling party is almost certain to lose. Opposition parties, from France Insoumise to the National Rally and the Socialists, have made it clear they will not back the government. What does that mean? Investors fear it could lead to either a snap election or the appointment of yet another fragile caretaker government. The uncertainty has already rattled bond markets, and the next big date on the calendar is September 12th, when Fitch will review France's sovereign debt rating. A downgrade could have serious implications for investor confidence and for the Eurozone as a whole. For years, Italy was seen as the unstable member of the Eurozone, with its debt burden and fragile governments. But now, France seems to be taking over that role. With a high debt-to-GDP ratio, political divisions, and rising borrowing costs, France risks becoming the weak link in Europe's financial stability. Investors are watching OATs, French government bonds, closely. If yields spike further, international confidence could erode quickly. Adding fuel to the fire, the European Central Bank meets on Thursday. The ECB is expected to keep rates on hold at 2%, and Christine Lagarde is likely to maintain a dovish bias. But here's the interesting part. The ECB has openly said it plans to remain deliberately uninformative about future interest rate decisions. That means Lagarde will almost certainly be asked about the chaos in France during her press conference. But don't expect clear answers. The ECB doesn't want to be seen as interfering in politics. Still, investors will be listening closely to every word. So, what do we learn from all this? On the one hand, we see how fragile corporate reputations can be. CEOs must lead with integrity because one personal misstep can shake entire organizations. On the other hand, the real financial storm is in the bond markets. With France under pressure, investors are facing uncertainty not seen in years. Combine that with the ECB's silence, and you have a recipe for volatility that could shape markets well into the fall. For investors, that means two things. Stay cautious in European debt markets. Yields could swing violently in the weeks ahead. Watch political risk as closely as economic data. Because in today's world, politics and markets are more intertwined than ever. This is Wealthy Business. If you found this analysis useful, hit like, subscribe, and share. And let's keep decoding the forces shaping global finance together.